Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Sherman.
Let's go. Welcome everyone to a new episode of Sparta Market Outlook. I'm Felipe Elink Sherman. I'm your host today, and I'm here with our commodity owners, our special market analysts, the specialists of the market, starting with Jorge Morinero. Hi, Jorge, how are you?
Hi, Felipe. Very good, thank you.
We also have Phil Jones-Lux. Hi, Hi, Phil, how are you?
Good, thank you.
And James Noel Beswick, our distillate specialist. Hi, how are you, James?
Yeah, very well, thanks. How about yourself?
Very good, very good. And all the way from Warsaw, but not Warsaw, Poland, but Warsaw, Indiana. I just discovered that right now, is our crude specialist, commodity owner, John Coleman. Hi, John, how are you?
Hi, Felipe. Happy to be representing the U.S. Midwest on the podcast today.
Absolutely. So it is not the same, if you look at the window, it's not the same old buildings in Warsaw. You have cornfields, if I'm correct, no?
Many rows of cornfields. Yeah, that's right. Yeah.
Okay, so today the idea is we've had obviously the last 2-3 weeks a Hurricane Trump situation with all kinds of tariffs, structures, and a lot of moving pieces. I think that we can all agree that even though this is far from finished, there's a sort of like a calm after the storm over the last days. And there's a certain tariff fatigue in the market. Everyone is a bit exhausted of the movements and what does it mean and what should I do and all that. So today we're trying to go back. Obviously we need to talk about tariffs a little bit, but we're trying to go back to fundamentals and to the oil dynamics. And obviously within, what are those tariffs? What are the impacts that we're seeing? But again, not making it all about tariffs, but trying to go back to fundamentals. But so you want to start, Phil, with giving us the big headlines or the main events happening this week?
Sure. And unfortunately, I do need to start just very quickly mentioning tariffs at least. And as you said, tariff fatigue. And currently, I think we're in a situation where globally the actual tariff burden is significantly lower than it was at first feared that it could be. We're in this pause on at least the reciprocal tariffs. So the focus kind of goes back onto demand destruction and where the various agencies and where we kind of see that shaping up for the rest of this year and into next year. Obviously, this can all turn around very quickly with all of the kind of, the fact that this is largely tariff driven. But if we just kind of take a look at what the IEA, EIA, and OPEC have all come out with over the last week or so, it's a pretty mixed bag. And you can see that we haven't really gotten away from this kind of narrative-driven view of demand that we've been talking about from these agencies previously. So OPEC have revised down their demand forecast for 2025 by about 100,000 barrels a day. The IEA, on the other hand, is about 400,000 barrels a day, or rather 400,000 barrels a day for the rest of the year. So 300,000 overall for 2025, given that actually Q1 looked as though it kind of came in relatively well supported. So there's still big discrepancies there. Actually, the EIA took almost 500,000 barrels a day off of their demand forecast for 2025. So, a pretty big range there between those agencies. And actually, one of the more interesting things, I think, and we'll get on to this with John, is that they all took off some supply estimates as well, largely lower expectations for US supply growth. But again, it was quite different between the agencies. So the IAEA took almost 260 KBD off of their supply estimate for 2025, 150k of which was in the US. OPEC didn't really change their supply outlook though. So it's an interesting kind of interesting dichotomy between those to keep an eye on. Overall though, as I said, this is all kind of on the basis maybe of expectations from when those reciprocal tariffs were still on. It's very difficult to know exactly when those expectations, when those timings from those agencies were made, and what kind of tariff world they were making them in. So maybe that explains some of that kind of spread between the different agencies there. Elsewhere, if we kind of move away from tariffs and looking at demand, although still demand related, I think China is a good story to talk about, or an interesting one at least, on the crude market in particular. So imports for March came in at a 19-month high, and that's obviously buying from kind of December, January. So before any of this, but also when margins weren't anything kind of particularly special. And so we've got this kind of now slightly higher baseline of imports in March. And when we're looking at term, now we're kind of looking at term allocations on OSP crudes for May loaders, because East Asia is looking at kind of July deliveries now. It looks as though China's taking 25% more in terms of its term allocations from Saudi, at least in May loaders than they did in April. And that's largely been driven by UNIPEC taking more of those allocations. It's unsurprising. The Saudi OSP came down quite a lot, so it's quite significantly more economical. We saw that in our tool as well. But then the question, I suppose, then is, what does that mean for the rest of the market, for the non-termed crudes? And it does mean that so far we're seeing still quite a bit of overhang for Angolan crudes, for Nigerian May loaders. The Chinese, it seems, are also kind of taking their time on deciding exactly how much Brazilian crude they're buying for those July delivery windows. So the rest of the market is in a little bit of pressure, I would say. But we'll talk about that with John later. It looks as though that increased supply and then lower OSPs from the Saudis in particular have maybe put a little bit more pressure back onto the spot markets.
So
and then finally, just kind of looking at overarching themes. I know it was mentioned on the pod last week, but it's still something which is relatively striking, and it's that difference between flat price and margins. So the impact that the last few weeks of volatility have had on both of those. So flat price, it's we're back to about 65 now. Brent around 60 on WTI. So it's still kind of pointing to demand fears essentially. Obviously the OPEC supply coming back as well, but refinery margins haven't really been fussed so far. At least we're not seeing kind of strong product pricing or refinery margin pricing telling us that end user demand is, or that people are kind of worried about end user demand. Q3 margins in particular, pretty much unchanged versus the start of this year, very much healthier than they were last year, for example. So everything in very workable territory. Maybe one thing to look into is mogas diesel spreads. So obviously those are something which typically at this time of year is maybe a trade that you might want to look at just seasonally, and I think we will go into it when we're talking about the individual products, but there is a very kind of slow, I think now gradual uptick in the gasoline market, in the Atlantic Basin gasoline market in particular. But I think for some people it might not be going fast enough. I'm hearing from a lot of the people that I'm talking about various refinery issues that they've heard about. People keep on trying to tell me about, oh, this refinery has an issue, that refinery has an issue, and no one else can quite verify that yet. So maybe it's true. Maybe there are a lot of refinery issues out there, or maybe it's just, we're in a position at the moment where the market could do with actually a little bit of news just to get us over the line and really start to kind of add some conviction to an otherwise very slow seasonal uptick in demand.
Yeah, but it's interesting what you're mentioning, this last point where, in a way the market is the market, but also the different agencies forecasting lower demand, which, we can all understand it makes sense, but the market at the same time is sending mixed signals where the margins are very positive. So, there's this elasticity of demand that maybe kick in, that these low prices, where it's not like a COVID kind of shock. It's a gradual shock that will eventually happen slowly as we start, as the impacts of the tariffs start unraveling, and to who, so
yeah,
it makes sense. I can understand why these margins are much better, and very healthy situation for refiners, and maybe we start seeing crude pulling back up, based on much better demand than expected. Yeah.
Yeah, I think demand forecasting is always something which is, not easy at the best of times, but I don't envy those agencies right now trying to unpick, very granular level impacts.
Yeah, and just before we move on to crude, with our Polish friend, Indiana, the Mogas diesel spread, my goodness, that's the rule number one. You try trading gasoline is do not touch that spread. That's the widow maker, they call it.
Yeah.
So when you said, hey, maybe that's something you guys want to look at, I had like these horrible nightmares from I don't know, 7-8 years ago. No, it's but yeah, anyway. So moving on to crude. John, what with flat price already nearly $10 per barrel off pre-famous Liberation Day, and 15 years from the highs, how will this impact the supply side for crude? What are your initial thoughts here?
Yeah, that's really a question that has rapidly come to the forefront here that I did not think we would be having discussions about just 1 month ago. But I think it's worth mentioning that U.S. supply is very much in question going forward at these price levels. So, like Phil mentioned, flat price is clearly responding to conditions much more aggressively than the margin side is. So maybe there's optimism that flat price will recover. But at these levels, it really becomes kind of a pain zone for U.S. producers for a couple of different reasons. So if anyone out there is not very familiar with the U.S. shale patch, it's very much a short cycle, high decline rate type of investment on the supply side. So you're having to drill a lot of wells to just replace production that's rapidly declining from older wells. What you'll see is a break-even value assigned to wells to monitor their economics. So generally speaking, an average or median break-even level for some of the middle of the road acreage in the U.S. will run you in the $60 to $65 a barrel is what's needed to incentivize producers to drill that well. So we're already in that zone. This is the average acreage. This isn't even like the marginal worst of the worst acreage. This is middle of the road acreage that's beginning to be out of the money. But when you layer on top of that the 25% steel import tariffs that Trump has also levied, I think people forget about that the retaliatory tariffs have come off, but the steel tariffs and other related things are still in place. Steel is a major input in drilling and completion in shale wells, such that a 25% tariff could translate loosely into a 5 to 10% uplift on well costs in the U.S. To put that in perspective, that's the equivalent of shifting the entire U.S. supply curve up 5 to 10%. So a well that previously broke even in the $60 to $65 range, maybe now doesn't break even until $65 to $70 range because of higher input costs. So multiple layers of pain for U.S. producers means that if prices stay at these levels, it's almost certain to see rigs start to roll off, capital budgets starting to get downgraded. You'll hear a lot about quote unquote high grading acreage and leaning into already drilled inventories, that sort of thing. But really the game plan shifts from a growth mentality to a stabilization mentality. And so what implicitly the market is doing at these price levels is saying we don't need US supply growth this year, whether that's a combination of accelerated OPEC supply returning to market or a grim outlook for demand that product markets are not currently reflecting. Either way, at these levels, the market's basically disincentivizing US producers from providing much material growth this year, which is quite a striking change from where we were just a month ago.
Yeah. So two things or two questions pop to mind. First one is how much of this is priced in? Because we started the year with pretty much every analyst out there saying that we had a massive oversupply situation. So from day one, we already knew that we didn't really need all of that supply. So now it's more targeted for the US. We don't need you. That's the first thing. So how much of that is priced in already at these kind of flat price levels? And with the context of what we talked about, that everyone is anticipating lower demand, but the cracks are telling us a different story. So that's my first question. Then I'll ask you a second one.
Yeah, no, it's a good question. So I think, before this calamity kicked off, WTI was in kind of a sweet spot for both producers and consumers, where 70 to 75 WTI is, where producers are incentivized to grow at a moderate pace, and you'll see 400 KBD of growth out of the US kind of chugging along at that level. It keeps OPEC happy that they're not considerably losing market share, because you still have demand growth above and beyond that. But really the two factors that came into play almost the same day, the tariffs obviously from Liberation Day that jolted the market, but then also almost lost in the background a little bit was that OPEC Plus decided to accelerate some of their unwinding of their production curtailments. So bringing in more supply and also darkening the demand outlook on the same day. So I think those two shocks have kind of left the market reeling to try to figure out where the new balance point is. And at this point, it's kind of just erring on the side that we don't need that much supply growth, given that OPEC is stepping into supply things and maybe demand might not be as robust. But to your point on margins, though, if that ends up being the correct narrative going forward, that business as usual demand is not as at risk as what flat price might be implying, I think you'll need to see that recovery in flat price to re-engage US producers before they start changing capital plans.
So that's my second question. Are we actually seeing this on a cash perspective? Are we seeing the impact already today on the cash side?
Yeah, so that's kind of a very interesting thing that I like to look at pretty much daily on our platform now is what's the fallout on the internals of the market and how WTI is pricing in a lot of its typical markets. Even we're getting questions from users on where we expect things like paper spreads for Brent TI to go and how wide are those going to need to be if WTI starts having trouble clearing. I think the first message is to set the context in that there was a lot of whiplash that occurred with how the White House decided to set that trade policy and change it and unwind it in very rapid, short order. But at the end of the day, as it stands now, the only material impact for WTI on the physical side is an effective closure of the Chinese market. And that was true 3 or 4 or 5 escalations ago on the tariff side with China. But to put that in perspective, that only accounts for roughly 200 to 400 KBD of WTI exports on a 4 million barrels a day export volume number. So you're really only talking about 5 to 10% of export volumes that have been truly displaced that have to find a new home for WTI at the moment. What we are seeing, though, is even with that modest amount of rehoming of WTI occurring, we are seeing WTI pricing more competitively than usual in various markets. Something we like to do is compare individual crudes to a competitive basket in regions to kind of assess how truly cheap or expensive they are. And right now, WTI is pricing roughly $1 cheaper than normal versus competing grades in Northwest Europe, and almost $1.50 cheaper than normal in Asian markets. And what that tells me is that even though a relatively modest amount of supply has been displaced, you could have other frictions coming into play where people are just changing buying patterns to be safe, to hedge, additional tweet risk from the current White House, so to speak. So in any case, WTI is looking cheap in the world, and it's clearly having to do that in order to reoptimize around a lot of the friction that was created after Liberation Day and the fallout from that. So
you're not seeing that sort of, we heard the big boss of the shale industry, I don't remember his name, asking people to stop drilling and to reduce production on the back of the economics that you mentioned before. But from what you're telling me here right now, we're not seeing that in the price action right now, and WTI is still cheaper. Because, again, if you want to make Trump happy, you just buy more oil from the US, and there's no easier kind of way of making him happy to buy a cheaper oil anyway. So you're not doing an exception. You're not doing it just to make him happy. You're just buying cheaper oil. So in a way, of course, we're not talking about China, but if it is cheaper than other origins, then something's not adding up here. What am I missing?
Absolutely. So yeah, like WTI. So like I said, 200 to 400 kbd that was going to China has to go somewhere else, and it's discounting a little bit to make that happen. I wouldn't call it anything massively dislocating at this point, but you're right. WTI, you might say, is on sale, so to speak, and we should see that be taken advantage of by opportunistic traders. I think one of the other sides of that consideration, though, is just how quickly policy can change, as we've seen in recent days and weeks, and that if you want to buy US volumes that might not arrive for 3 months in the Asian market, a lot can change over those 3 months, and your qualitative risk might be a little bit higher on buying WTI volumes today from a policy perspective. So I think there might be some trepidation in the market as well, just from the whiplash that we've seen recently. But I would expect that WTI currently is not having difficulty finding a home. It's just what I would call a reoptimization around the closure of the Chinese market, and that WTI should converge back to normal price levels.
So it seems like a buying opportunity here.
Absolutely.
Okay. So with that in mind, let's move on to LPG, or night ends in general, but starting with LPG. Big story last week around the real product that actually had an impact from the tariffs directly, not through potential demand loss, but actual supply shifts is LPG. What else have we learned this week, Jorge, and what is worth mentioning today?
Yeah, I think we could start with a review on the pricing side. Since in the last podcast, we talked a lot about this history, and what we have seen is a rebound on the main indicators, not just flat price, but time spreads and crack. They are not back in the previous levels, but they have been trading higher for 1 week. So I think the market overreacted a little bit to the first headline on the spike of sanctions from China to the US. And this week we have seen higher tariffs. Probably we will see higher ones in the coming days. But the market is more back to a physical reality where time spreads and cracks are going back to the previous level. And another thing I would highlight, because we talk a lot about it, is that the main drop was on the Far East Index for propane and butane, and it impacts very strong on the differential with Mont Belvieu, with CP, and with Northwest Europe. And we talk about there could be a potential reversal on that, and we have seen that through during the last week.
Carry on. Yeah.
Yeah, and then we can move to the petchem side. We have talked a little bit about the feedstock. Last week we were more focused about the feedstock, but let's focus on the pure petchems. So we have seen a downtrend in the prices, as everybody was expecting. There is a trade war ongoing, weaker flat prices, so it has been felt also on the petrochemical side with lower ethylene and propylene prices. This is something I said last week. This is not just after the tariff. We have been seeing this, especially in the West, since middle of February, much before the tariffs. But right now the trend is getting stronger. So we are seeing further drops, and there are right now news, all speculative, but that we could see a very big drop in the export of final products from China to US. Some sources talk about an 80% in 2 years. So that would be a very, very strong downtrend, and it could impact ethylene and propylene prices even more. But there is one thing I honestly was not expecting, but it's very linked to what Phil has said in the beginning. Talking about the margins, the drop in final products, well, in ethylene and propylene, has been lower than the drop in the feedstock. So right now, if you look at the margins on the petchem side, they are higher than before the start of the war of the tariff war. So this is like very linked to what we have seen in crude and in refinery margins. And with this, like I would like to separate the story into impact, and one of them can be a bullish case for naphtha demand indeed in the coming months. First, we have a short time shock on the feedstock. So less LPG goes from US to China, and that's an immediate impact. So it impacts on the feedstock. But as Phil has said, the demand estimation are much harder to predict. So the shock in the feedstock is something that is happening right now. Some traders are looking for alternative destinations in the east other than China, but the demand is harder to predict. First, we would have to wait 3-4 months to see any impact, and then maybe is US going to replace the final goods from Europe? Are they going to keep importing from China at a higher level? What's the percentage of the demand that is going to be impacted? So all these two stories, one is short term, one is medium term, and they have very different impacts on the light ends market. Because the short term one is what we saw 2 weeks ago, a very big drop on LPG prices. But the long term story is weaker from a macroeconomic perspective. So if you go into a new market where the optimization is less than before, the economical, the world is going to feel it on a macroeconomical perspective. And looking at the short-term impact, with less LPG available for China, PDH mainly, I can imagine a spike on naphtha demand. We have seen a recovery also on cash diffs, in time spreads, in cracks during these days. The market is very volatile, so it doesn't say anything about the coming months. But if the production that is going to be replaced from China comes from the US, the demand for naphtha in the US and also in other regions in Southeast Asia and so on, so the naphtha demand could see an spike. Also in China, if you have less PDH, you have to produce more petrochemicals relying on naphtha demand. So that's I think that's the most interesting point for this week, like this to split this impact between the short-term feedstock and the long-term final goods. And a couple bullets apart from that, something I'm also seeing on the naphtha market. We have big headlines. One is the possible turnaround of Sparta refinery, which is the biggest producer of naphtha in the Med. So this is gonna come in May, June. It's a product that goes to the east. It can stay in Northwest Europe crackers. So we're gonna feel it. It's going to bring us a tighter market than expected during spring at the beginning of summer. And we are also seeing it on East West. Despite the big drop in cash diffs in the east, we have seen a rally in the East West, and I think it can be very linked to this. So yeah, I think I'm switching a little bit my perspective compared to last week on the naphtha market.
Very clear, very clear. And yes, your comment about the petchem. Obviously, it's a very illiquid market, the petchem market relative to oil. So the price impact or the readjustment of prices is a slower one. It's a phenomenal opportunity for people to produce. And I think that we had this debate with Neil last week where I was saying, if you're a Chinese producer, what are you going to do? Of a petchem producer, 20% of your demand evaporates, so there's a shock. But the reality, as he was saying, and once again, he was right, is what you're seeing is just the demand is the same globally. You're just having a reallocation of the supply. But so in theory, the demand for on a very short term, there is maybe a shock, and there hence the flat price collapsing. But ultimately, the demand is still going to be there for these petchems, even more now that the flat prices are lower. And it's just a question of who supplies who. But the overall mass balance remains the same. So
Yeah.
and that's what the market is telling you with these higher margins. Yeah.
Yeah, exactly.
Yeah,
And the liquidity of the products is a very good point. We talked about it yesterday in our market meeting, because when you look at ethylene and propylene in the East, you're looking at weekly assessment, kind of fair value. When you look at MOPJ, you look at a very liquid instrument. So there is a lag between both prices. So I think it's very early to make an estimation about what these margins are going to be. But in the short term, we are seeing a very big spike on there.
Okay. Moving on to middle distillates. James,
Hi.
can you give us a general overview first to start with?
Yeah, well, I must admit the kind of diesel and jet markets compared to what we've been talking about before, it's a little bit of a damp squib currently. So we've got kind of cracks globally, very steady and range bound over the last fortnight, really. Not much movement there, not much to talk about. We've seen a little bit of strength in kind of global middle distillate spreads, probably mostly in the East. Singapore jet and diesel spreads are at the highest level in over a month, for example. But not a massive move up, to be honest. Heating oil and ice gas oil spreads, a slight move up, but kind of quite range bound as well. So we've got Asia, as we spoke about with the spreads, we've seen some tightness emerge. And I guess we expect that to continue into the medium term. As we discussed, Singapore diesel and jet spreads have moved to the highest level in over a month. And as such, the East-West has kind of continued to narrow. I think mostly driven by the fact that East Asia still is moving towards its kind of peak turnaround period, probably towards the end of May, beginning of June. So we should see Asia pulling more diesel, at least from AG, West Coast India, from the Middle East in the short to medium term east. And therefore some slight reduction in these flows west into Europe and into New York, Pad 1. We've also seen some demand from kind of West Coast, South America, West Coast, Central America. So we've seen the like Ulsan, South Korean ARBs open into US West Coast since the start of April. We've also seen some reported fixtures from this region into kind of East Coast Mexico, East Coast Central America over the last week or so. And Singapore diesel stocks are quite relatively low currently, but have seemed to have found a little bit of a floor over the last week or so, and should probably be expected to rise slightly from here. Now, moving on to the US, we've seen, for example, Brazilian diesel premium really fall off a cliff over the last week or so. And that US Gulf TA ARB into Europe is marginally open, probably definitely workable for refiners. And because of that depreciation in Brazilian premium as well, pointing at Northwest Europe rather than Central America, or Latin America even, sorry, forgive me, currently. We've seen TC14 continue to move down. That's transatlantic MR freights. But our freight experts think that's probably a bit of a flaw in that now because of the rumors of the USTR announcement on April 17th regarding increased US port fees for Chinese ships. And also we've seen US crude runs continue to improve as well. So though US distillate stocks, particularly diesel, are reasonably low still, we should see them to start to quite rapidly increase from here, I believe. Now, moving on to Europe, as we spoke about before, we've seen swing Middle Eastern diesel ARBs continue to increasingly point east, partly on the back of that east-west narrowing movement I spoke about just a few minutes ago. We said as also that the US Gulf ARB is marginally workable for refiners into Europe as well. We're also seeing that Middle Eastern diesel ARBs are pointing east. Middle Eastern jet ARBs are pointing west pretty strongly, actually, and are open into Northwest Europe and the Med. And I guess something we should talk about some context, maybe why we're seeing a little bit of strength in ice gas oil spreads maybe over the last week, is that we're starting to see some relief over the next week or so for those Rhine low water levels that we've seen over the last couple of weeks. Therefore, that kind of built up demand in kind of Central Europe should offer some short-term relief to ice gas oil spreads and cracks maybe. But kind of all of that, and mostly because of the increasing runs in both the US and Europe now, I kind of have a mildly bearish view on kind of European distillate pricing. Perhaps not in the immediate short term, but the medium term long trajectory I think is bearish. But I guess really kind of why it's felt like a bit of a damp squib compared to everyone else is that I don't really have a very strong view about that really now. I could see some mild hiccups to the positive side. We spoke about already strength in Asia due to increasing turnarounds there, a somewhat reduction in Russian diesel exports as well, Rhine water levels that we spoke about before as well. I mean, stocks in both the EU, Europe and the US are relatively low currently, although I expect them to grow from here, but that could also, some short-term demand shocks to the positive side. And also, I guess, kind of more global context, there still continues to be strong signs of increased diesel demand in emerging economies, Brazil, Turkey, India, etc. But overall, my overall view is that as we've got European and US runs improving quite dramatically from here now, that's kind of what's mainly forcing me to have a mildly bearish view from here. The strength in Asia being important to monitor as part of that picture.
Interesting. Yeah, as you said, as you guys were talking, I kept hearing a bit more of a bullish sentiment, whether it was crude flat price, WTI relative to other crudes, the rebound on different products driven by higher margin, or in theory the cracks indicating that there is demand for these products, and diesel, and again diesel is theoretically the one that is closer to the economic reality of the world, is maybe not the one that is that is telling us a cautious story there, if you want. Phil, you had
it just
a
kind
question?
of feels that any kind of moves now will be quite range bound, I guess, on diesel moving forward. I mean, if you look at the market structure of spreads, so ice gas oil, heating, or Singapore less, but they're kind of all kind of slowly moving into contango around like July, August time now. I guess that points, I think, generally to how I see the market, like a general gradual bearish movement moving forward.
Yeah,
thanks.
That is a great point to finish on, because I think actually it's something we've seen both in crude and in products, that kind of prompt spreads have slightly rebounded or are looking kind of all right, but the deferred spreads have actually taken a bit of a beating over the last week or two. So those, as you said, the spreads, when we look kind of a little bit further down the curve, are all have all come off a lot more than the prompt has anyway. So I don't know if that's maybe reflecting kind of this expectation that some of the fallout, at least, isn't so immediate, but maybe there's a slightly worsened sentiment in the medium term. Very, very final one, and my apologies, because I know that this is something that I mentioned to you at the beginning of the week about the USTR announcements on Chinese port fees. Breaking news from Michael on our Market Outlook section on the platform. He says that they've backtracked on that, so TC14 slightly less bullish than we otherwise would have thought.
Thanks.
Which I suppose probably helps to keep those that USTA movement coming into Europe, and maybe contributes a bit to your bearish outlook.
Indeed, that's great. Thanks. That's really interesting.
Before we wrap up, Jorge, one product we haven't really talked about that much is gasoline. Or Phil, I don't know if you guys want to talk about gasoline, giving a little bit of an update here, or.
Sure. Yeah, it's similar to diesel in that I think there are other things that are taking the headlines at the moment, and that's fine. I mentioned at the top of the podcast that it's maybe there's a few elements that can point to some seasonal gradual kind of upticks, but it's going to be a slow one, I think. So quick wrap up. The TA arb is very narrow at the moment, but it's being offset by quite a weak TC2 and very wide gas nap in Europe. So I suppose that depends on your outlook now for whether those European naphtha margins, the steam cracker margins or the naphtha market in general in Europe should improve, but there's not too much in the way to say, I think TAR has probably hit a floor for now, but it's going to be kind of a very slow return upwards. And worth a very quick update because it's been a theme basically for the whole year so far. Those Reformat premiums that we keep talking about are still basically flatlining, and we're getting into now second half of April, and because we haven't seen any kind of uptick really or movement in that prompt market, it's starting to bring down our expectations for Reformat and other high octane premiums for May and June as well. Just as those kind of prompt.
Despite the positive blending margins that we were talking about,
Yeah. So those positive blend margins have come off now essentially. So May and June blend margins are they're already negative again. The RBOB arb is looking worse again May and June, and it's all very balanced into the Atlantic Basin for kind of your Brazilian and your LATAM grades. Actually, something to mention that the East-West is still hovering at near $6 a barrel, and at these kind of levels, we're seeing the AG is now a very competitive alternative for WAF barrels on an LR at least versus ARA for kind of late May, June arrival especially, and that's when, depending on who you believe at the moment, I think either the Dangote FCC is already down or it's going down soon. So expectations of potentially lower supply out of Dangote through this quarter at least, and just at the right time for the AG LRs to be competitive into WAF. So I think there's a few reasons why we've got a bit of a ceiling on the Atlantic Basin gasoline market at the moment, and seasonally it should improve, but there are some headwinds essentially.
And just a last little element here, ARA did threaten the Mexican outlet, no? For it was cheaper than Houston going into Mexico. Is that the case?
Yeah, we've had a lot of volatility over the last couple of weeks, and part of that was that for a moment at least, 3 or 4 days, the ARA outlet was looking cheaper into Canada. It was looking cheaper into Mexico, into much of LATAM. The response to that seems to have been pretty quick actually, and the Houston MTBE premium, which had been kind of slightly creeping up, responded almost immediately to that threat, essentially to that outlet in its backyard, and fell to kind of recapture those outlets for Houston blenders. So as did the Gulf Coast RBOB spread widened to help that as well. So yeah, there was a couple of days where you could see it in our ARBs outlooks, and as is very typical for when you see these particularly kind of big signal ARBs moving one way or another, moving to kind of unusual levels, as this was, price responded pretty quickly to reestablish that status quo.
Very clear. So look, I mean, just by listening to what you guys are saying, it seems that we're still in this wait and see scenario, and what the opportunities that we are discussing here are a balancing act when there was an excess in price movements, whether it's flat price, whether it's LPG, whether it's this correction on the front end of the curve where the spreads are coming up a little bit and correcting to the upside, whereas the back end of the curve is now. So there's this sort of realignment post frenzy, craziness, etc., but without a very clear direction, I would say. So that's the trade right now, is just this realignment. Now with a little bit more time and calmness. Yeah, I would say. With maybe your naphtha story, that's something that to keep an eye on, Jorge. That's definitely something that is
Yeah, because there has to be a rebalancing in physical flow. So there's a physical reality underlying the pricing movements.
Yeah, sorry, what I meant to say is a much more structural kind of thing that can be very interesting in the short term rebalancing, but also midterm structural.
Oh yeah.
Yeah. Mm-hmm.
Yeah.
It's the first time in quite a while that I've heard anybody talking about kind of, let's say, Japanese, South Korean, Taiwanese naphtha steam crackers in anything other than a kind of, structural decline type of narrative. There is propylene and ethylene that needs to be produced now, and if it's not coming out of Chinese PDHs to go back to the US, then yeah, we've got that.
Very clear. Well, thanks, guys. This has been a great show, and looking forward to talk to you next week. Thank you very much.
Yeah, thank you too.
Thank you.
Take care.
Bye-bye.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.